Hello everyone, and welcome to my channel. This video mainly introduces you to the loan agreement. What is a credit agreement? A credit agreement is a legally binding contract that records the terms of the loan agreement. It is the borrower and the lender by a person or party. The credit agreement outlines all the terms related to the loan. Create a credit agreement for retail and institutional loans. Before the lender can use the funds provided by the borrower, it is often necessary to sign a credit agreement. Key points: a credit agreement is a legally binding contract that records the terms of the loan agreement. It is the borrower and the lender by a person or party. A credit agreement is part of the process of providing guarantees for many different types of loans, including mortgages, credit cards, car loans, etc. Before the borrower can use the funds provided by the lender, it is often necessary to sign a credit agreement. How a credit agreement works: the retail customer credit agreement will vary depending on the type of credit issued to the customer. Customers can apply for credit card, personal loans, mortgage loans, and revolving credit accounts. Each credit product has its own industry credit agreement standard. In many cases, the terms of the credit agreement for retail loan products will be provided in writing to the borrower's credit application. Therefore, the credit application can also be used as a credit agreement. The lender provides full disclosure of all terms of the loan in the credit agreement. Important loan terms included in the credit agreement include the annual interest rate, how the interest rate of the loan applies to the outstanding balance, any fees associated with the account, the loan term, payment terms, and any consequences of delayed payment. Compared with non-revolving loans, revolving loan accounts generally have a more streamlined application and credit agreement process. Non-revolving loans, such as personal loans and mortgage loans, usually require a wider range of credit applications. These types of loans usually have a more formal credit agreement process. This process may require the lender and the customer to sign a credit agreement and reach an agreement in the final stage of the transaction process. The contract is only considered valid after both parties have signed it. Institutional credit transactions also include revolving and non-revolving credit options. However, they are much more complicated than retail agreements. They may also include the issuance of bonds or bond syndicated loans, where multiple lenders invest in a structured loan product. Institutional credit agreements usually involve lead underwriters. The underwriter negotiates all the terms of the loan agreement. The terms of the transaction will include interest rates, payment terms, credit terms, and any penalties for late payments. Underwriters also promote multi-party participation in loans, as well as any structured parts that may have their own terms separately. Institutional credit agreements must be agreed and signed by all relevant parties. In many cases, these credit agreements must also be filed and approved with the U.S. Securities and Exchange Commission, SEC. Examples of credit agreements: Sarah took a loan of $45,000 from the local bank. She agreed to a 60-month loan with an interest rate of 5.27%. The credit agreement stipulates that for the next 5 years, she must pay $855 on the 15th of each month. The credit agreement says that Sarah will pay $6,287 in interest. It also lists all other expenses related to the loan and the consequences of the borrower's breach of the credit agreement. After Sarah read the credit agreement thoroughly, she signed the agreement and agreed to all the terms listed in the agreement. The lender should also sign a credit agreement, which is legally. If the lender agrees to pay part of the borrower's loan, another adjustment will be made to the mortgage coupon rate at the end of the period. The delivery cost refers to the cost that the borrower expects to pay higher than the price of the property in order to complete the transaction. Examples of settlement costs include loan origination fees, evaluation fees, title insurance, property taxes, and contract recording fees. In the case of the lender's credit, the lender pays part of the settlement cost, reducing the amount of cash that the borrower needs to submit a settlement statement. In exchange for the lender's credit, the borrower agrees to pay a higher mortgage interest rate. If the borrower works with an intermediary mortgage broker, a premium may be required to compensate the broker. The final interest rate that the borrower agrees to pay after the adjustment is called the adjusted coupon rate. All details of the coupon rate and coupon rate adjustment